How can we know if a company is making or losing money? How much money is the company generating? And is this amount increasing or decreasing over the years? Well, we can find out by reading the company's income statement. This is one out of three key financial statements that tell us the health and wealth of a company. This video is an overview and an introduction into how to read a company's income statements. The income statement of a company is also known as its profit and loss statement. Now it functions to tell us the revenues and expenses of that particular company over a given period of time. So the first thing to note from this definition is that income statements are for specified period of time. Now normally the time frame is for 1 year, so the income statement is going to reflect the business activities that happened throughout the year. So the financial year in the company is 31st December, then we're looking at activities that happen from January 1st to December 31st. And if the year end is March 31st, then we're looking at activities from April 1st to March 31st. From our definition, we also see that the income statement is a reflection of all the revenues and expenses of the company. Now, the income statement may look different from company to company, but they more or less follow the same basic structure. And this basic structure is probably something you're going to find quite familiar. So, how do you know how much money you saved this month? So normally we might calculate it by first starting with how much money did we receive, right? So if we have a job, how much salary did we receive this month? Then perhaps what we can do is deduct all the money that we spent this month. Maybe we spent money on our rent or mortgage, insurance, food, entertainment, or other things. How much did we spend this month? So what is left over is what we have saved. So if we spent less than what we made, then this month we have savings. But if we spent more than what we made, then we're not going to have any savings this month. So a company's income statement pretty much works in the same way. We first start out with the sales, all the revenue that the company made for that year. Then we deduct all the expenses the company incurred in the same year. And the results of that is either a profit or a loss for the year. So let's take a closer look using an example. This right here is the income statement of Apple. For the purpose of this demonstration, what we're looking at is actually the summarized version of the income statement. You can get these summarized income statements for free on websites such as Yahoo Finance or Morningstar. Now, if you want to see the full detailed income statement, or perhaps you want to see the entire financial statement of the company, then you can go to the company's website and you should be able to find it there. Alright, so first up, what we see is that this income statement has specified time periods. It's stated over here that Apple's financial year end happens in September. So each of these statements are for the period from October 1st to September 30th. This column over here with the heading TTM means the trailing 12 months. So this column is updated every quarter and reflects the results from the last 4 quarters. We also see that this income statement is stated in millions US dollars. So this number here may look like 365,000, but because this sheet is denominated in millions, so it's more like 365,000 million, which is 365 billion. Alright, what's the first line on the income statement? It is the company's revenue. This number reflects the amount of sales that the company made throughout the year. Then from here, we deduct the expenses. Typically for company income statements, expenses are divided into 2 different categories. The first type of expenses are known as the costs of revenue or costs of sales. These are basically direct costs that the company has to incur in order to generate that revenue. So things like raw materials that are used to manufacture products, or like salaries of factory workers that assemble those products. So after we deduct the direct costs from the revenue, what we get is the gross profit. The second group of expenses are the operating expenses. Now these are indirect costs that the company has to incur regardless of its performance. Things like paying rent for your office, the salaries of your admin staff, your accountants, your lawyers. We can see here for Apple, what they have classified is research and development costs as well as sales and marketing costs. After we deduct the operating expenses from the gross profit, we get the operating profit or loss. So in a nutshell, we see that this follows a very simple basic structure. How much the company made this year, deduct how much the company spent this year. If the end result is positive, then the company has made profits. If the end result is negative, then the company has made losses. So some companies may also have this additional section here, which includes incomes and expenses that are not related to the main business operations. So incomes like this maybe is, the company made some investments and they received some dividend income. Or maybe it's income from selling off some of their assets. And expenses that may fall under this category may be interest that's paid on loans as well as tax. So we see here at work the basic structure of a company's income statements. We start out with the revenue or the sales figure, then we deduct the direct manufacturing costs and the indirect operating expenses to give us the profit or loss for the year. Alright, that's all for this introduction video. I hope it gives you a better idea of how to read income statements. Next up, we're going to be talking about balance sheets and cash flow statements, so stay tuned.